Ryan here from Mortgage Choice, and today I want to talk about self-managed super funds, or SMSFs for short. What are they? What are the pros and cons? And is a self-managed super fund right for me? Now, before we start, just a bit of a disclaimer. The information in this video is for general education purposes only and does not constitute specialist advice. It has been prepared without taking into account your particular objectives, financial situation, or needs, and you should consider its appropriateness to your situation before taking action. It's important to note that SMSFs are not for everyone, so please seek some advice before deciding if an SMSF is right for you. Now, did you know a comfortable retirement, according to the Association of Superannuation Funds of Australia, suggests that a couple needs about $72,000 per annum to fund a comfortable lifestyle, assuming they own their home outright. According to the Australian Bureau of Statistics, in FY21, the government pension remained the main source of income for most retirees. The age pension for a couple is less than $40,000 per annum and less than $25,000 per annum for a single person. Super tends to be one of the largest assets people have. Despite this, most people don't know the current balance of their super fund, which company manages their super fund, or the individual who manages their fund. Now, how much income will you need in retirement? Now, the average super balance for men between the retirement age of 60 to 64 is around $370,000. And for women, the average balance is around $290,000. As mentioned before, to fund a comfortable lifestyle, according to recent reports, a couple needs around $72,000 per annum. How does that compare to your current income? When asked, most of our clients indicate that they want to have income of around $100,000 per annum in retirement. Downsizing the family home is not always the only solution. If we work backwards and assume you have assets generating around a 5% return or yield, you will need around $1,440,000 of net assets in addition to having your own home paid off to generate $72,000 of income per year in retirement. To generate $100,000, you will need net assets of around $2 million. As mentioned, the average super balance for men between the retirement age of 60 to 64 is around $370,000, and for women, the average balance is around $290,000. So as you can see, so many people fall quite short. Planning for retirement early is crucial, as we see too many clients leave planning to a couple of years prior to retirement, meaning they end up with debt in retirement, something that you want to try and avoid at all costs. So what can you do to get your net assets to a sufficient level outside of your personal assets? Enter self-managed super funds, SMSFs for short. Now, what is an SMSF? To prepare better for retirement, lots of Australians are establishing an SMSF as another avenue to purchase investment properties, shares, and ultimately invest in their future. An SMSF is a private superannuation fund that you manage yourself rather than having it overseen by an industry superannuation fund. SMSFs are a popular choice for those who want more control over their retirement investments, including the choice of investment options and direct management of the fund. Now, here are some key points on SMSFs. You have control over what you can invest in, like shares, property, and fixed income products. SMSFs are regulated by the Australian Tax Office and the Australian Securities and Investments Commission. There are strict rules you must adhere to, so you need the assistance of a financial advisor and accountant. Costs. Establishing and running an SMSF can be costly, as you need the assistance of a financial advisor and an accountant. It's typically most cost effective if the fund has a substantial amount of money to manage, generally suggested to be at least $200,000. Now, what are the pros and cons of an SMSF? Let's start with the pros. You have more control over one of your biggest assets. Income earned from the SMSF is taxed significantly lower than personal income tax rates for most individuals. When you retire, the income you receive from the SMSF may be tax-free. If you sell a property when you retire, the sale proceeds are generally tax-free, i.e., no capital gains tax is payable. If you decide to keep a property in retirement, all the rent you earn may be tax-free. Now, what are the cons? Costs. SMSFs cost money to establish and run. Regulation. There is a lot of regulation in SMSFs, so you need to engage a professional to assist you in running it. You cannot generally access assets of the SMSFs until you retire. Now, is an SMSF right for me? SMSFs generally offer benefits like being able to invest in assets or use certain strategies that may not be available to you in other types of super funds. This doesn't mean that setting up an SMSF is the right move for you. There are a few issues you need to consider first. With an SMSF, they are heavily regulated. You are in charge of the SMSF. You must be willing to spend the time needed to manage your investments. We can introduce you to a specialist SMSF advisor who can help you understand what's involved and whether or not an SMSF is right for you. Remember, planning for your retirement early is crucial. Start making the time today to plan for your retirement. Make your retirement years as rewarding and secure as they should be.